Good morning, everybody. Welcome to the second day of our workshop, Interdisciplinary Research Workshop, FinTech, Finance, Technology and Regulation. I'm very happy to see the new faces today. So we are very happy you joined us. Yesterday was really nice day for us just to get to know each other. You know, we had a nice chance to talk in the groups, to network a little bit. To walk around the city and to network also. So hopefully you are happy about yesterday. And today we will have the day even more interesting because we are having the business representative joining us today. So, but let me first start from our honorable guest today, who is online with us. From the early morning in Cambridge. Good morning, Professor Andrei Kirilenko. We have the keynote lecture by the professor, Andrei Kirilenko. He's Professor of Finance, founding director of the Cambridge Center for Finance, Technology and Regulation, University of Cambridge. Good morning, Professor. Do you hear us?
I can hear you very well, and can you hear me?
Okay, so thank you very much for joining and looking forward to your lecture. Thank you so much.
Thank you for having me. I'd like to also start by thanking the University of Lithuania for opening up its classrooms to Ukrainians, to Lithuanian people for opening up their hearts and their homes to Ukrainians, and Lithuanian Seimas for adopting really powerful political resolutions in support of Ukraine. I'm Ukrainian originally. I'm originally from Mariupol. The city has been destroyed. My mom died there during a siege, and it is a pleasure to be here with you. One of the things that happened during this war and during the changes that went on, and I've been told by several people that crypto has saved lives. So there has been some rethinking about this particular technology and these particular types of assets in terms of their social impact. Today, I will talk primarily about the financial aspects of how I and my co-author Sylvia, who is now at UCL, think about crypto assets. Let me begin with the following slide, with the definition slide, before we talk about what will follow. Let's agree first of all on what I would be talking about. So I define a crypto asset as an intangible, in the sense that it does not have a physical form, digital asset whose issuance, sale, or transfer are secured by cryptography. Cryptography, there are typically two cryptographic primitives that go into a crypto asset. One of them a cryptographic hash function, and the other is some sort of asymmetric encryption protocol. In Bitcoin, for example, we have SHA-256 cryptographic hash function. Hash function is what enables the encryption of transactions into blocks and then stringing them together with the hash function of the previous block becoming input into a new block. And asymmetric encryption technology enables signing off each of the transactions so that each transaction is actually also encrypted. So it's a form of a database that is also shared electronically. So it's shared electronically. It exists on many different computers. And that way it solves the so-called single point of failure problem. Single point of failure is, of course, a common problem in business, and that, let's say you're running a business, doesn't have to be a financial services business, any business. And you have customers and you have suppliers, and you keep your records of what you're doing on a computer. Something happens to that computer, it crashes or it gets infected, your business is compromised. So one of the ways of dealing with that is storing the data on many computers. But then, of course, you have a problem. How do you synchronize the database that's stored on many computers? It is done through electronic communication and through a variety of consensus algorithms, so that different computers in that distributed database are able to communicate to each other and agree what is the copy that in which is considered the golden record. A particular database for a crypto asset is, of course, just not any data, but a ledger. It's a ledger of issuance, of sale, or transfer of records. So that's what I define as a crypto asset. Another way of saying that is crypto asset is a software. So when we will be talking about optimal investment or something that has to do with finance, where the value comes from, and how this value is transferred over time and across different possibilities, we're talking about software. So we will be talking, so investing in crypto assets would be investing in different types of software. Each one of these crypto assets comes with its own software supported by hardware that's provided by those who adopt this software. So when you download an app onto your smartphone, you are downloading software. What would make that software valuable? What would make your text messenger valuable? What would make your any really app that provides some utility to you valuable is potentially something similar to what makes crypto assets valuable. So it's a software, and it's a software that's actually typically written in the open source protocol. It's a software that basically anyone could see the actual what the software is if you have the ability to see that. It's a software that I said has two primitives embedded in it. One of that has to do with encryption, and the other has to do with distributed computing. So it's a software that's distributed on a network of computers. And so those two things are going to be what's different about the different types of software underlying, or different software that underline each of these assets. That's how I think about it, which just sort of helps me orient myself about what crypto assets are, and when money is attached to it or value is somehow attached to it, what does this value represent? The software has to have certain properties to it that are valuable. The original software that took the world by storm is Bitcoin. You can see on the lower right part of this quite outdated crypto assets map, but this is the sort of the very good sort of graphical representation of the universe of assets at that point in time is Bitcoin and its variants and its forks. Bitcoin is a very particular type of software. It has a very particular type of cryptography, a very particular type of consensus algorithm, which most of you probably will know, if not all of you will know. And it became popular. Lots and lots of people have downloaded or used some way to connect to it. the next iteration of the software. So Bitcoin software, as you know, was proposed in 2008 and really started going in 2009. That's pre-smartphone. So that was it's designed as a desktop computer software. You can interact with it now using other devices, but it was not explicitly designed, and it's clear in its design, for smartphones. The next iteration of this software came about with Ethereum about 5 years later, which was designed specifically for mobile devices, and designed with a framework of mobile devices in mind, that is smartphones, of course, it's a misnomer. It's a portable computer that you hold. It's not really a phone. Audio functionality is one of the probably simplest things that it does, or smallest things that it does. So you have a portable computer that you can carry around, and you have applications in that device. And Ethereum was designed with that in mind, that it's a software that enables its participants to have distributed decentralized application, DApps, right? So you have now applications that work on many devices. So you need to synchronize them now, and underlying it is a token that enables that to happen. Then there were other types of assets that came on board, which I view as variants or changes in two of the aspects of the crypto assets. One is, what is the different cryptographic technology that's being used? More secure, more anonymous, more difficult to figure out who is behind each transaction. And as these transactions are assembled into blocks, how secure these blocks are when they're being strung together. So you have your Monero in there, and others. You also have various iterations of the consensus algorithm that enables faster throughput, faster processing, more transactions, a larger number of transactions per block. And then you also start having on top of that base layer and the interactive layer over it. So you can also think of that the base layer of it is really this, global payment system. You start having things being built on top of it. You have decentralized exchanges, you have different types of wallets, you have, then the next layer of iteration over this is, of course, decentralized finance, where you're interacting, you can contribute now your assets to these platforms. There's stable coins that are not here. Stable coins then enable transitioning among fiat money and crypto money much faster and much simpler. So you have layers that are built on top of this original protocol. Again, even as the layers are being built, even as sort of some form of financial services is being provided, the base foundation of it rests on its software. It's software that's underlying it. It's an open source software. And so, as with software that you're familiar with, for example, text messengers, we know that, especially open source software, the value of it, how valuable it is and how useful it becomes, hinges on network effects. I'm not the first one to notice that. Of course, it's known that network effects are very, very powerful, especially in software and in the digital realm, if you will. small improvements or small changes, small positive changes, or small valuable changes, or small desired changes in one software relative to another software leads through adoption, disappears of the one that's marginally less useful, and widespread adoption of the one that is just slightly better. We know that we had, for example, multiple internet browsers, and then through adoption, there's a massive convergence to one. That happens in the space of, in the digital domain. We have multiple text messengers, however, so we don't all use WhatsApp. So some use WhatsApp, some use Telegram, some use other types of messengers. Signal, again, depending on how securely encrypted you want your communication to be and how many others are using it. So again, it's software. It is typically free to adopt, and it provides some value. And there will be many sort of suppliers of software, but most of it, and there is already research that shows that most of these sort of crypto assets will disappear, and only some of them will remain and potentially become very, very valuable. Once we start to understand and once to figure out sort of where does the value come from in this software, that's the first part. The first part is network effects. So we're looking at it. This is software. Software is subject to network effects. So we have some sort of principles that we're going to look at. Just as a reminder to you, so network effects, just so we all sort of on the same page, is a demand side rather than a supply side or transactions cost or information or learning phenomenon. It is a demand side phenomenon. It comes about because of adoption, because of demand. It doesn't come about because of frictions, because of costs, because of learning. It's the adoption is what drives network effects. So it is, as you can see, has a exponential type of pattern to it. And that, of course, leads, as I said before, to a winner-takes-all type of scenarios, especially in a digital domain in which the costs of adoption, the costs of downloading an app are zeros, effectively marginal costs, right? So network effects will be coming from the demand side or coming from the demand side. On the supply side, we need to perhaps roll back a bit and think about, okay, it's software, but it is being used as money. It is being used as an asset, and money, of course, is one type of an asset that's used for exchange for other assets. So let me take us back here to a paper, a book, really, that was authored by Friedrich Hayek, one of the people who is, I would say, that one of the founding fathers of modern finance, was his price theory, his realization, or his postulate, if you will, that prices are functions that aggregate dispersed information and then signal that information to the rest of the market. And that way market forces could learn from that information and channel resources. It's a very, very powerful theory that has proven to be correct. We've seen authoritarian regimes and central planned economies around the world effectively collapse without, the support of others who want to keep them around. Less known work of Hayek's and sort of less adopted, but in my opinion, no less powerful, is his argument on the denationalization of money. And I will read to you from directly a quote from that argument. "I have now no doubt whatever that private enterprise, if it had not been prevented by government, could and would long ago have provided the public with a choice of currencies. And those that prevailed in the competition would have been essentially stable in value and would have prevented both excessive stimulation of investment and the consequent periods of contraction. So as you know, now we are in the environment in which inflation is rising, across the globe. The recent inflation numbers in the US, UK, Europe are at the levels that have not been seen since practically the 1970s. Of course, it is realized that part of it has to do with the stimulus that have been provided during COVID. Part of it has to do with geopolitical uncertainty and the disruption of supply chains. Part of it has to do with sort of changes in economies that have happened as a result of some digitization. So there are many parts to it, but what effectively it signifies is that there was a central bank reaction before, and now it is showing up. It's not the first time that excessive stimulation of investment or consumption has subsequently resulted in inflation, and then subsequently resulted in additional action that led to contraction. So Hayek is not discussing something that we haven't seen before. Let me read you some more detail about what specifically the logic of Hayek's argument is. And the logic goes as follows. There is no answer in the available literature to the question why a government monopoly on the provision of money is universally regarded as indispensable. I agree with that. There's still no answer in the available literature. We have a lot of literature, but there is no consensus answer on why government monopoly in the provision of money is indispensable. It's there, but it doesn't necessarily mean that it's indispensable. It has the defects of all monopolies. One must use their product even if it is unsatisfactory, and above all, it prevents the discovery of better methods of satisfying a need for which a monopolist has no incentive. I do not think it an exaggeration to say that history is largely a history of inflation, and usually of inflations engineered by governments and for the gain of government. We have always had bad money because private enterprise was not permitted to give us a better one. So that's the logic of Hayek's argument. Whenever you have a monopoly, a monopolist is going to extract gains in the form of, extract rents in the form of seigniorage, for example, and not going to innovate on the services that this particular product or service that is being supplied. It's not sort of a new revolutionary idea, but thinking of provision of government money that way puts it into a new light. Until now, because when money becomes software, it is unlikely the government or governments will be best positioned to provide that software. So what we've seen happen is that Bitcoin was proposed in 2008 explicitly, actually, in response to the global financial crisis. It's written into its code. It was in response to government bailouts. It went live in 2009. And what happened after that is that regulators were busy. I was a regulator during and after the global financial crisis. I was at the US Commodity Futures Trading Commission as part of the team that was redesigning the derivatives environment. Regulators were busy. Yes, regulators were extremely busy with the global financial crisis and the European banking crisis that came after that. And really, nobody was really paying much attention to this software money. There were so many other things to deal with. I mean, there were banks collapsing, there were public money being used, economies need to be rescued, all sorts of types of market participants had to be reevaluated. The nature of products, or the types of products and the type of intermediation that's being provided in this markets on a global scale was reevaluated and redesigned. So regulators were busy. So that gave a window opportunity for Bitcoin and then Ethereum to actually adopt it on a wide enough scale. As regulators were busy doing something else, things were happening in the software domain that were not seen as at least threatening. Let's put it this way. I first came across, listened to the founder of Ethereum in about 2015 when it was about to go live, and I personally thought it was in some basement near MIT. I was there at the time, and I personally thought that these people are a religious sect. You know, they have their founder, who is, the founder of Bitcoin, who is just sort of mythical figure that's not a person. They have their saints and apostles, they have their religion, they have their particular jargon. They're all very excited about it. And of course, I'm just coming as a regulator, former regulator from the global financial crisis, traumatized by it. I'm looking at these people like, what are you smoking? This is not going anywhere because it's not how things are. I was wrong. Software is powerful, and the adoption of software eventually led to a situation where one of the giants in the software space, Facebook at the time, proposed its own digital currency, Libra, in 2019. That got regulators to react, because that's not just software that's just adopted by some people and then they sort of play around with it. It is a big tech company with billions of users who have already adopted its software. And if they have already adopted its software, providing them with just additional specifications, additional attributes of that software becomes trivial, and they're available on a global scale. So you see here Stefan Ingves, who is one of the most respected central bankers around the world. He's the central bank of Riksbank, Sweden. And he explicitly said that Libra coin, a catalyst for central banks to rethink role. So of course, different countries have their own different roles that they have to rethink. One of the roles that the Swedish central bank was rethinking at the time was the use of notes and coins in circulation. Increasingly, notes and coins were not being used in Sweden. People were using digital means to or other means to pay, and therefore was natural to think of what can be offered. And so work on central bank digital currencies went into overdrive after that. There have been many prototypes created. There's been a lot of talk among central bankers. Libra was the onslaught of central bankers against Libra because they already organized and they were already probably knew just how powerful that software is. You can say has been successful. They killed it. So, and themselves, they started developing central bank digital currencies, which brings me to sort of a bit of an anecdote. Before I was a regulator in the US, there was a period of my time where I worked for the International Monetary Fund. And I work for various parts of the International Monetary Fund that have to do with money. They're being called different things. Monetary and Exchange Affairs Department, International Capital Markets Departments, Monetary and Financial Capital Departments, can't remember. They keep changing names. And originally that department was called Central Banking. And then it wasn't just about central banking, and then it was become about the banking system, and then the monetary system, and then the financial system, as it became evident that how money is created and how money is interrelated and how it moves about has to involve not just what central banks do, but what commercial banks do, how they interact with the rest of the world. And one of the missions that I was in, probably one of the more interesting missions, I was part of a mission, technical assistance mission, that came to Lithuania, to Vilnius, and our job was to put together a blueprint for Lithuania, for the central bank, and to repeg Lithuania currency from the US dollar, to which it was originally pegged, to the euro. So we had to come up with a blueprint of how to go about it. What do you do? And that involved sort of multiple aspects. And I remember working with my colleagues, having an initial meeting with the colleagues at the Central Bank of Lithuania, and trying to explain how we're going to go about it. And the person who was in charge of on the other side, the counterpart was a person trained in mathematics. So he was a former mathematician. He was in charge of the department of the central bank that was tasked with that particular objective. How do you repeg your currency in a way that is trusted, so that the repeg happens and nobody pays attention? That was the goal. How do you go from a peg from dollar to euro, because it was evident that Lithuania was going to join, was joining the Eurozone, and hence there was a need to change that peg. It kind of doesn't make sense to have your currency pegged to the US dollar if you're joining the Eurozone, right? So you have to repeg a bit in advance without losing trust. So we were talking to each other how we're going to go about it. And then we're speaking past each other. I'm saying something, he's saying something, and sort of not understanding what we are. And I said, okay, how about this? We think of it as a blueprint. We think of it as a sequence of actions that we're going to take. We're going to draw a tree of what possible contingencies are out there, and we're going to go through that tree and attach actions. And then once we've designed that tree and we design the actions and counter actions, we're going to come up with a system that will get us there. And then things clicked, because finally we were speaking the same language. We were speaking the language of math. We're speaking topology. We are now in the, we may not have been in the same topological space, but we're now in isomorphic topological space. So my space and his space could now mesh. And from that point on, things were clear. So similarly here, once you start thinking of this as a software, how can the central bank design an architecture in which you can deploy this software safely, usefully, and in a way that presumably central bank thinks could serve its role and function, whatever that new rethought role is. So we've seen central banks thinking about it and designing these blueprints, if you will, and how they want to go about it. Bank of England has one, the US has one, Ukraine has one, Eurozone has at least one, Canada has one. I've seen them, they are operational, they could be deployed as, they have been deployed as pilots. China has, of course, deployed a very large pilot within itself. They don't call it a digital currency, they call it something else, electronic money and payment system, but it's effectively that. So led central banks to start thinking, okay, if money is software now, or increasingly starts looking like software, how do we think of encrypting the software? How do we think of communicating the software? What does the software do? Who is in charge of changing specifications of the software? How do we coordinate on different types of software? How do we make sure that the software is not just dropped, and so therefore our functionality is impeded? But at the same time, software is amazing because you can program it. You can make programmable money, which is amazing, right? You can all of a sudden start thinking about programming that you can add to the functionality of an asset that was sort of more like a calculator than a computer. Now, once it's in a computer and it has the whole power of math and computer science behind it, you can program it. That's amazing. You can do a lot with it. However, as you're programming that software, as we said, it is known, it has been known that, probably governments are not the best software architects or engineers. So it's unlikely they're going to design something that is best. They may be best for them, or it may serve their mandate that they have. But how do we think sort of more broadly about it? So that brings us to questions. Broadly speaking, so should these crypto entities, those who write, who design, who deploy and operate this software, should they be like traditional firms? How about those who participate in the trading of these sort of attributes that are embedded in the software? Should that be done is the way the trading was done before? And should crypto assets, again, that are software, really be treated like traditional securities? These are sort of big questions. And the answer is yes, maybe. Yes, in principle, digitally native and non-digitally native assets could be thought of as same in terms of the value they provide. Maybe, maybe not. But you can ask yourself a question and again, think of Hayek again. Where does value come from? Why is something valuable? Well, something is valuable because it preserves value over time and in different states of the world, right? Well, where does value of Bitcoin come from? What does it preserve and in what states of the world that was not priced previously by existing securities? We have some theories of it. We don't have a universal theory of value. We don't have consensus answer of where value of crypto assets comes from. We have some ideas. However, we also know how we typically approach this. We approach this from the point of view of demand and supply. Demand is driven by network effects. We've sort of talked about that, and it seems intuitive, and a number of people in this space, including those who've been in this for a while, agree with that. And economists who are looking at it from the outside also agree with that. So something that has to do with demand. And then we think of, well, who supplies these assets? Should that be only central banks that supply these assets like they do now? Or should there be private suppliers of these assets? Should we always rely only on software that's supplied by, your sort of Ministry of Digital Transformation or whatever it could be called, Ministry of Digital Assets? Or perhaps that's not necessarily that's going to lead us to, the best designs. And how do we govern successive redesigns of this software? Who is in charge? Who are the core developers? How is it done? How can we monitor them? Because once you have software, of course, it gets outdated, sometimes very quickly. So how does the redesign happen? Who is in charge of it? So I'll show you a framework that Sylvia and I have put together to sort of think about it in the fairly stylized way that gets us to some answers, at least. the way we think about it is that, as I said, we just sort of looked at this software, and we said, well, what are the fundamental primitives that are embedded in it? Well, there are two fundamental primitives, as I decided before. There's some cryptographic technology, and there's some technology to govern it, the distributed computing technology. So you have cryptographic technology coming from us, you have distributed computing technology that governs the consensus algorithm coming from distributed computing. Well, okay, so perhaps this is the way to think about what are the intrinsic features of these different types of software that are called crypto assets. So on the security side, we can say, well, let's just say that there is a continuum of security features that is normalized between 0 and 1, and you go from low security to high security, and of course it symbolizes the cryptographic protocols that are embedded in this. You can have a variety of different types of protocols, but you need to have something to encrypt communication for each transaction, so that each transaction is in some way cryptographically protected. And you also need to have something that strings together blocks at a minimum. You can have additional elements to it. You can have these blocks, once you strung them together, you can encrypt them, you can slice them digitally, you can shred them, you can place them somewhere so that no one could actually, just sort of tinker with them. But at a minute, you will have something on the security sides. On the stability, that's what we call another element of it. You have, it's coming from distributed computing. The decentralization of this type of software, placing it on different computers is solving the problem that is solving is a single point of failure. The one I described to you before, that you don't keep this database with valuable stuff all on one computer, because it could crash, it could be hacked, could be attacked, it could be, the database could be changed by someone who gets into it, or by some hardware error. So it's on many computers. Once it's on many computers, they have to coordinate, they have to communicate to each other and coordinate how does the database go from state A to state B. Computers are state machines. So how do all of these states are synchronized? And you have different ways to synchronize them. You have proof of work, you have proof of stake, you have PBFT. So there are many ways to ensure that even if no one can be trusted on this network, and that's typically the assumption, no node could be considered trustworthy. It's either a zero trust architecture or partial trust architecture. There is still trust stays inside the database because of the way the software is written, because through communication, an answer will appear that either a majority or less than a majority or greater than a majority of participants are going to agree on, and that will create stability. That will make sure that this database doesn't just disappear or change in some very unpredictable way. So these are our metrics. So a way to think of it in the space of in the way financial assets are typically analyzed, or where their value comes from, there is a cross-sectional valuation of assets. You have different stocks, and you put at a point in time in a cross-section, and you say, well, why is a value of Apple now is different from the value of Microsoft now, is different from the value of Google now? What is the difference? How can we value these assets in a cross-section? And we have some theories of how we do that. We teach them to our students how to value assets in a cross-section, depending on the type of asset that we have. And we value stocks one way, we value derivatives another way, we value commodities another way. Stability, I think of as a time series attribute. How well does it hold value, or how much the value could change because again, you're changing states, you're moving over time, you're adding blocks, you're changing states, and how is it stable? How stable is your architecture to make sure that takes place? So we can now have the whole universe of crypto assets and say, okay, so if these are the two stylized attributes, we put stability also on a normalized scale, right? If these are our assets, then these are the fundamental attributes that are going to be valued. These are the valuable attributes, stylized valuable attributes in that software. And we, just broadly thought of how would, for example, different types of assets that are present now, broadly we'll speak. We're in a stylized, more mathematical world now, but for example, central bank digital currencies could be thought of to be designed to be highly secure and highly stable. Stable coins would be designed to be highly stable, but with low security. You can also say that some stable coins become crypto tokens. So not only that they have low security, but they also have low stability. We've just seen a stable coin basically disappearing, becoming so unstable that it's no more, right? So there is here, what calls itself a stable coin, but actually is a crypto token, is going to be really determined by these fundamentals rather than the name. Cryptocurrencies, we can think of having high security, but low stability. They could go through periods of boom and bust. So, okay, so we can organize our thoughts on that. So that's on the supply side. So any crypto asset, which is a piece of software, could be thought of now as different from other crypto assets along two dimensions: security and stability that are stylized. The way to sort of think about it in the fiat world, you can think of security is something similar to how paper money is protected from counterfeiting. So you have various attributes that are designed to make it very, very difficult to create, counterfeit money. That's security. Stability, you can think of, and this is the entrance to the building of the Federal Reserve Board in Washington, D.C., is the governance structure, is what determines how stable the value would be of that asset that you're going to pay for other assets. So that's the difference. So one of them has to do, you can see how you can separate the two into the two characteristics that don't bleed into each other, because what you do on the security side is one thing, what you do on the stability side is another. So you can take it now into the attributes of your software. How about demand? We said that demand is probably what's going to drive this. And we say, okay, so how do we model demand? How do we think about demand? And the way we think about demand is we say, well, it's a software, so let's think of it as an app. Let's think of it as demand for these assets actually could be described as embedded inside the architecture of an app, right? So the way we think about it is that there will be investors who will be demanding these different attributes over a digital platform. So this digital platform, it is going to store information about available crypto assets. It's going to collect preferences and provide investor-specific recommendations. So the way we're going to model this process is by thinking of a stylized app. I mean, you can, economists sometimes design models in which they have a central planner. Even though it's a model of a market economy, they say, what would a central planner do? And so here we have an app that is going to learn, and importantly, it's a learning app, and it's a recommender app, really. And the way we think about it is sort of similar to recommender apps that like dating apps, for example, a recommender app. So you have the apps that you that you use when you go out and select a movie. That's a recommender app, right? So it's going to provide investor-specific recommendations. So think of it as a layer on top of the supply of crypto assets that's going to incorporate information about demand and make specific recommendations. So the architecture of it, we have a supply of N assets, and they have two different features, security and stability. And then the crypto app would know what these assets are. And then we have market participants, we have K investors, and they have risk preferences towards security, stability, and the return on the portfolio of these assets that they wish to attain. So these are financial investors. They're not interested in it just to play with it. They're interested in it because it could carry value for them from some states to other states. And what the app is going to do is going to ask each one of these investors for what their preferences are individually. Other investors don't know what the answers are. So the app knows, the app learns over time. And it's going to recommend to them different crypto assets in pairs. It's going to say, pick this one or that one. Do you want, Asian or Mediterranean? You want to go to dinner. So you want to go Asian or do you want to go Mediterranean? Okay, you choose. And then it will ask you again, it will ask you a series of questions. And then based on that, based on what you accept or reject, it's going to keep updating state. It's going to learn from all the investors, not just from you. And that's the power, of course, of recommender apps, is that they not only learn from your preferences, they learn from what everybody else is doing, and they recommend to typically go into Netflix or Amazon Prime or something, Amazon Video or others, and they will tell you, most popular movies in the UK or US or wherever you are now, and they're like, oh, this is the most popular movie, maybe I should watch it too, right? So or by category. So it will make recommendations. So over time, it will learn. Again, this is our stylized version of how we think the forces within this economy are going to operate. It's digital. It is recommending to you different types of software for your use. I mean, again, when you're choosing movies, you're choosing digital products. And that will get it to update the state. It will iterate, and eventually it will lead to something. So what we want to say is like, what would happen if we let this run? This is just the math of it. I already explained to you in words what we're going to try to do. We're going to model adoption, and we're going to model the probability of change of state. These betas are preferences on different security, stability, and return on the asset. And then this is demand. This is how we model demand. So supply we think of is, since it's open source products, any combination on the continuum of these assets could be supplied. On the demand side, some will be adopted and some will not be. So what would it be? So we will be, the way we're going to get to that adoption is, again, these are financial investors. They're interested in returns, and these returns depend on what others are doing. And as you can see, the change in adoption feeds here into return. If, these are speculative investors and they think, well, if I adopt and others adopt, then the value of it is going to be higher. Not deterministically, because we have there an error term that is a function of stability, how stable it is, how well it is governed. But over time, this is sort of the iterative objective function that investors are solving in terms of expected returns. And again, adding some speculation to it, expected return on this asset is expected to be such that if others adopt, then the value rises. So let me get to this. I am not seeing. Okay, here I am. So here's what we've done. So we've set. I'll play this for you. So we've run some simulations on it, and it is not moving. Let me try to make it move again. It's loading. Anyway, we've run some simulations, and we set all the betas to 1. And we said, okay, if we set all the betas to 1, meaning that the preferences towards security, stability, and return are the same. They're just equal in terms of what investors want. We're going to simulate. For some reason, it's fairly slow. Well, I know for which reason. We're going to simulate. We're going to start with a number of assets, and we're going to run it through the simulation exercise, and we're going to see, do we get any clustering? And what we get is that we get, you can count as 4 or you can count as 3 type of clusters. So you can see that you have expected return on one axis, and then you have probability of not being adopted, so the opposite of being adopted. So the probability of not being adopted is close to 1. That is exactly what that means. If your probability of not being adopted is 0, you're in the sort of central bank digital currency space because it provides other utility. Could be negative, actually. Expected return, for example, on an asset that we could call, for example, that it resembles central bank digital currencies, could be negative because it provides utility for which asset holders are willing to pay. Just like inflation erodes the value of your notes and coins, here it will be value that is actually expected return is negative. So you expect to lose money on this, but it's still being adopted. And then you have assets in the middle that are more like cryptocurrencies, stable coins, and then you have crypto tokens. So you have a separation, and that's what we're trying to address: a separation of different types of assets. We looked at so it's not a cloud of points. It's not like we don't know. We run this mechanism and through adoption, and we still don't know. We have an idea that there will be just a handful of these assets that are going to be winners. They're going to differ by security and stability, by what they provide. And we can change investor preferences, and you can see as you change investor preferences, remember there's beta 1 and beta 2 are their preferences, their loadings on security and stability. You can go from, four different types of assets to 2 different types of assets to even 1. You can see in the middle, it sort of bunches up. You can separate them into 2, where you only have central bank digital currencies and something very, very speculative as crypto tokens. Or you can have everything bunch up together where it's effectively stable coins, or you can think of that it's some sort of a software layer on top of sort of central bank standard notes and coins. We play then the types of investors and changes in the ecosystem, how how our recommender app is designed. We get sort of similar results in that we get clustering, which that we even had an actual app built, so you can actually go to cryptomender.com and play with it. You will see how it works. I encourage you to do so. It's learning from others, and it's going to recommend to you, based on your preferences for security and stability, what would be the optimal portfolio for you of crypto assets based on what you're doing and based on what others are adopting. Of course, this is not investment advice. This is just for educational purposes. It's there for you to have a demo. I teach these courses often as demos. It's easier sometimes to describe software in the form of a demo. That's how often software is presented as a demo in terms of its functionality. So think of it as a demo that you can actually download onto your smartphone or use on your laptop. So in summary, I'd like to communicate to you that I think of crypto assets as software money. And that's perhaps a way to think about approaching it in terms of where the value of it comes from. You can think of this as software that is a particular type of software. It's distributed. It's a software that runs on a distributed system, and it's a software that maintains an encrypted database. And that's where these are potentially its valuable characteristics, because now, why did I say in the beginning that we are rethinking what it can do? You can think that it's a toy, it's whatever, but if you have to flee your home that's just been bombed and you don't have much time to do anything, but you brought your smartphone with you, and you can you have a wallet, or you can create a wallet which could be populated with resources that you can use to save your life, that becomes much less of a toy, doesn't it? And that's what happened. A number of crypto exchanges, Binance, Kraken, FTX, have populated wallets of displaced Ukrainians with crypto assets, which you can spend on buying food, buying medicine, paying for transportation if you need to. Buying food and buying medicine could save lives, and it has, as I've been told. So you can take it with you anywhere where there is internet. It works. It doesn't require anything more than any other software. You also need a software to communicate with your loved ones. You need the software to say, I'm fine, I'm safe. Again, that is very, very important at this time. So there's rethinking going on about how valuable that is, because we are now in the environment where the value of it has actually been tested, and it has proven to be, well, we're in the world of sort of fiat money, where the central banks are now trying to figure out how to deal with inflation and how to deal with the stability of prices. We're also in the other world of software money, which is saving lives. So while establishing its legitimate position. So I'd like to stand here. I'd like to stop here. I'd like to thank you for your attention. If there's time and desire to ask me any questions, of course, please do.
Thank you so much, Professor. Are there any questions? Okay.
Hello, Professor.
Thank you.
Hello, hello, okay. Thank you so much. It was a break for our microphone. Okay, so I'm taking the microphone to the question.
Hello, Professor. Thanks for this nice presentation. I have two questions, if I may. The first one is, I did not understand why stablecoins are considered as low security assets. It's my first question. And the second one concerns the definition of a security feature. And I was wondering, do you consider crypto asset selection as regard to a specific standard, for instance, for Bitcoin? Because for many researchers, Bitcoin's value is a kind of a standard of reference for the stability or instability of other crypto assets. So is it that kind of idea you have in mind?
Right. Thank you for your questions. I think the gist of the question is sort of classifying existing assets into sort of the category, stylized category that we have created. This is a stylized category of two attributes, security and stability. And so when we assign sort of existing assets into it, we may or may not be perfect in doing so. Because we are in a sort of stylized space, and you can say, well, stablecoin, why is it low security and high stability? Why can't it be both high security and high stability? I would say I've seen stablecoins that you can think of as very stable, and they remain stable, and then they become highly unstable, right? Their value sort of evaporates, or their value starts fluctuating. On the security side, the design features of that software are such, for again, as far as I understand, is that it's stable coins are issued, or let's just say this, the design features of that software are such that the supply of that asset is actually much more centralized. So unlike Bitcoin, if you will, where the supply of Coinbase is you can say is distributed to miners who provide certain services, and anyone could in principle become a miner and provide the services, solve the cryptographic puzzle, and then the supply is generated. The supply of stable coins, as far as I know, is quite centralized. So there's this issue of having having a database that is now in one place where the decisions are made on how many Tether or Luna to supply are potentially seem to me are more cryptographically are more vulnerable than in other environments. But again, this is a subject of we're in a stylized world. You can say that stable coins are they call themselves stable, so they're stable, and they say that we're highly encrypted, and therefore they are. They, as you can see in our simulation, stable coins and cryptocurrencies are sort of there, sort of next to each other many times. And from what I've seen, one of the things that stable coins have done once they came on board is they primarily solved the sort of crypto to fiat link. Whereas before, we had arbitrage opportunities, across a variety of exchanges, for example, Bitcoin, US dollar rate. Now, for the most part, it's disappeared, because before you had various frictions. So they solved that sort of friction problem. They provided, if you will, internal sort of, these are, sort of connectors between fiat money and crypto money. How well are they protected? I mean, they sit in wallets. The supply, they sit in a database. The supply is determined by what seems like more or less centralized decisions. So that's why we sort of put them that way. On Bitcoin as sort of the gold standard for it, I would say yes. Bitcoin is definitely a gold standard in the proof of work for the proof of work consensus algorithm. It is, it seems that it is a gold standard in that space. And since we only have effectively two largest assets, which is Bitcoin and Ether, and they're both proof of work as of now, you can say, well, Bitcoin is really the reference. If and when Ethereum Foundation does move to a different consensus algorithm protocol, for example, proof of stake, we will see potentially that one of these assets is going to be priced based on proof of work architecture, and the other asset will be priced based on the proof of stake. And then there may be more of a decoupling, because for now, you will say that, you know, the two major reference assets, if you will, which, by the way, Commodity Futures Trading Commission and Tether, as well, along with them, has designated as commodities. So Bitcoin, Ether, and Tether have all been designated by the US CFTC as commodities, which is very, very interesting development. I don't necessarily disagree with that, especially for Bitcoin, because I call these things assets, right? We'll say these are crypto assets, but no one is liable for Bitcoin. So when people say Bitcoin is like digital gold, I mean, it's a metaphor, but it's not too far-fetched in the sense that, like, you can't take Earth to court and you say, oh, give me more gold or give me less gold, right? You know, why isn't there more gold? I mean, no one is liable for gold. Gold is an asset, but it's no one's liability, right? Whereas, you know, central bank money is the liability of central banks. It's on a balance sheet of central banks, and you can, you know, complain to, if you're in a democratic environment, to your politicians about what central bankers are doing, and they will be changed, and they will change the balance sheets. So in that regard, designating them as commodities, designating these sort of software pieces as commodities is an interesting development. I agree with you. It's a reference asset for now, but that's simply because the proof of work has become, not simply, in my opinion, that's because one of the fundamental features that's become so widely adopted is this particular type of consensus. Hopefully I answered your questions, at least somewhat. Sorry about the rambling.
Is it working? Okay.
Saulius Masteka, Vilnius University. I just maybe would like to ask a short question. As, let's say, I'm going to invest, should I invest my time in central bank digital currencies? Because if we make an assumption that it's the most stable, the most secure, but as Hayek told in his work, it is going to devalue over the time. Even in Rome, we had silver coins, but less and less and less silver were in the coin. So is it really stable and secure? And your opinion about the future of central bank digital currencies? Thanks.
Thank you. Right, so there are two types of designs for central bank digital currencies that they're sort of playing around with. There is a design it's a layered architecture. So one of the things that central banks do, which is incredibly valuable, is they provide payment, they facilitate payment services. So sometimes central banks have explicit mandate over payments. Sometimes this payment is taken out to a different regulator, prudential, the payments regulator in some jurisdictions, like in the UK. But effectively, there is a provider of payment services. Payment backbone is absolutely critical for money. So as you know, money is generated in two ways. One of that is central bank money, and the other is commercial bank money, or money that is those who are licensed to generate money through credit. Payments is absolutely critical to that, because once you combine credit money and central bank money, they become fungible. They become indistinguishable from each other. You take credit from a bank, and then you can use it to go to an ATM and take out notes and coins. And that happens because of the provision of payment services. And this is a highly secured architecture. There are typically several of them being provided. access to this payment backbone is typically only for those who are licensed to access it, and that is typically, again, your licensed financial institutions. They're the ones who are licensed to create money, and they're licensed the ones to maintain records, maintain ledgers vis-a-vis the central bank and vis-a-vis others of, issuance of, coin base, if you will, in the form of credit and transfer of value. So the central banks currently are discussing two types of systems. One, why should payment systems be only available to commercial banks, to financial institutions? What if we make payment system available not just to commercial banks, but to others? Then the question is, which others, right? Do we make it available to everyone? If we make it available to everyone, including individuals, so this is what's called retail central bank digital currencies, then you could have an account at your central bank. Your money is actually stored at the central bank. And then the services provided to you for your money are financial institutions are competing for. They say, oh, I want to provide you the best services to send money abroad. They're like, fine, sure, I'll work with you. Or I could provide you the best checking account, or I could provide you the best savings account, or you can buy securities from me. Now you see where this leads. And there's some central banks around the world which actually, in the past, as you know, central banks as government institutions is relatively recent. So in the past, central banks were actually private banks. They were just had the monopoly to from the government to do what they did. So the it doesn't take a very large model to see that there will be a strong adoption in principle of under some fairly simple conditions of central banks as providers of these services, and pretty much your banking system is going to be competing for in a very competitive environment for in the downward in the race in which they will have fewer and fewer rents, because the competition is going to be, well, how much cheaper can you do it? So we all now are accustomed to free checking accounts. Well, free checking accounts came about actually as a result of fintech competition with banks, and then they had to compete for and they said, okay, free checking accounts for anyone. They don't necessarily want to provide free checking accounts if they don't have to. Or we've seen how cross-border transactions, fees for cross-border transactions have come down to, from, $30 to nothing, basically, to pennies, if that all. Right, so you will have a banking system that what central bankers would say is becoming disintermediated, which is they are really not comfortable doing that. They're a regulator. If they're disintermediating something that they're regulating, then what are they doing? So they're not entirely comfortable with that. Then there is, of course, the other version of it. Okay, so we're not going to give access to everyone. We're not going to have access to individuals to create accounts with a central bank accounts with a central bank. What we're going to do is we're going to create a backbone, a payment system, and then we are going to open it to competition, and then the provision of actual wallet type of services and access to the payment system and that sort of thing is going to be done through by private participants. So it's kind of like we'll maintain the intranet, and then others will deploy on top of the intranet. And then we'll see what happens. They know what's going to happen, but it will take longer. They know that the winner takes all is going to create monopolies or oligopolies in the provision of those services. But they're kind of like, look, we'll make them regulated, we'll deal with them, but they are providing software services, right? So that's where things are. That's where things are moving. If that is, so the second design is sort of currently winning the hearts of central bankers. They're not necessarily, again, particularly happy to go down that route, but at least that's more familiar to them. At least there's someone to regulate who's left. So so that's where sort of things are going. And in a way, an answer to your question is, I think you're going to be forced to, right? You know, you will be probably in an environment where your salary will come to you in central bank digital currency at first as an option, and increasingly as that's the only way. You know, it's probably now being deposited electronically into your account with the bank, and that's, you know, it's going to be deposited into your account with the bank with the central bank money, right? So you'll be told to pay taxes in that form. You'll be told that every time that you're applying for any sort of government service, you have to pay for it in that form. So the government is going to use their monopoly over other elements of what they control to force that choice onto the participants. Of course, then the question is like, okay, if this is software, if this is globally available, you know, we're going to end up with 3 currencies, you know, around the world, because how are the central banks, you know, central bank in the US, in the EU and China are not necessarily worried, but, or if you're part of the Eurozone, but if you're a central bank somewhere else, you've seen dollarization before, you know where it leads. You lose control over basically what happens in your economy. So unless you move and have your own central bank digital currency to provide something, maybe with a woomph, you know, your economic agents are going to adopt something else. So you probably don't need to think much about it in Lithuania. You know, it's probably much more of an issue for many other places that are going to try to maintain their own sort of monetary policy and seigniorage, because in a way, you know, the decision of where you are has already been made, you know. So I think in your case, it's going to be sort of a moot point. You know, it's not going to be an asset, it's just going to be something that's going to be forced upon you. Hope I answered the question in some way.
Thank you very much. Would you like to comment? We have one small comment from Vilnius University.
Please.
Thank you. Lindas Butenas from Vilnius University and Superhow company. I think I'm very happy to see your presentation today, because for the last 4 years working in this sphere, I was going around the conferences and asking the people how you define, how you understand that the tokenomics and the crypto models that you create will be sustainable and long-living. And usually what I get back, an answer was what tool they use was Microsoft Excel. So that was disappointing. And now I really see the model basis on which not even investors, but the creators of the system can start building their understanding if the value, what they create, their ideas, would be sustainable and interesting for the early adopters, for the later investors, for the second market. So yeah, I'm very happy to see that model, and I think we will cooperate in the future. Thank you.
Thank you. Yeah, really appreciate it. It's very stylized. It's very, very kind of you to say that. Sylvia and I have been trying to build the simplest possible model that retains sort of the logic, but as you said, moves over, you know, moves beyond sort of like, well, blockchain is kind of like an Excel spreadsheet that's on multiple computers. Well, yeah, but then it's kind of like, why do we need it? So I appreciate that you see that what, you know, that what we're trying to do is resonating with you. Thank you.
So thank you very much, Professor, for being with us today and for sharing your thoughts and insights. So we are actually very tight in the time link, you know, and the agenda, so we need to move forward. And one more thing, we are sending all the support from our side to you personally and to Ukraine. So we are with you with all our hearts and our minds. Thank you very much.
Thank you. Thank you for having me.
Okay.
Have a great rest of the conference. Bye-bye.